reportsonhousing.com, coming to you live on Facebook and YouTube. I feel like Mr. Rogers when I'm getting ready, but all right, let's go ahead and get started. I'm not going to wait for a whole bunch of people to come on. They can watch this the beginning at a later time. I just wanted to get rolling really quick. Because this is live, it is prone to errors. I looked, hey, we're good. We're live. Let's just go ahead and begin this thing. So let me share my screen, and here we go. All right, so another housing debrief, and just want to get right into it. Let's see. Of course. Let's see. Oh, be right back. Need to be able to toggle from screen to screen, and in order to do that, got to plug in my pointer. Anyhow, we still use those things. So I'd like to thank our sponsor, Kevin Buddy from Monarch Coast Financial. And of course, dealing with more than one kind of borrow, it requires more than one kind of loan. Deals with everything from full documentation loans to alternative documentation loans to investor financing and even private money. So pretty much everything that has to do with lending, Kevin Buddy has got your back. He has loads and loads of experience. Kevin Buddy's been doing this since 1976. He's my personal lender as well. Does such a fantastic job. He just helped us refinance our home. He's my buddy and your buddy, Kevin Buddy at Monarch Coast Financial. And you can have him help out you or your clients both. And you can give him a call at 949-422-2075. That's 949-422-2075. And thanks again, Kevin, for your continued support. So our company is Reports on Housing. It's your local real estate snapshot. Yes, I am the nerd. I have that degree, that quantitative economics and decision sciences degree from the University of California, San Diego. And that is what I draw from in all of my analysis. And I geek out on it. Absolutely love it. You can ask my wife. She'll wonder, where did you disappear to? It'll be late at night and I'm down in the office taking a look at some chart or something new that just popped into my mind that I needed to dissect a little bit deeper. So that makes me a nerd with the quantitative economic decision sciences major. We have reports. We're subscription-based. We have them dotted all over Southern California. We're actually looking to expand to other areas as well. And the most recent report is forbearance, foreclosures, and facts. All 5 counties have gotten it, which means that Orange County, Los Angeles, and San Diego on Monday and Tuesday for San Diego, we'll be getting the next report. We're right now in the process of crunching all the numbers from last night. And I do have some of those numbers for all of Southern California for you right now. So look for a new report to come out coming up Monday. If you actually sign up, you will get that most recent report, forbearance, foreclosures, and facts, because I'm all about dispelling all the myths with facts and figures and data and stats. That's really what it's about. So let's get right into it. Reportsonhousing.com. You can go there to subscribe, and it's $15 per month or $150 per year. And you get a month free if you sign up utilizing the coupon code August. So let's talk about the inventory crisis that is upon us. Yes, there is an inventory crisis. And it's like red alert out there. And my sirens were blaring a lot earlier. People were wondering, what in the world? How did we get to this point? That is exactly what the big question is how did we really get here? And you got to peel back the onion a little bit, take a look at housing. And of course, right now it is absolutely insane. It's insanity. And that's the market that we live in right now. And with the insane market and the insane pace and the way that it's like auction-like atmosphere, we've had values just come up like crazy. They've just been screaming upwards. Now, it surpasses what we did in 2012 and 2013. And that in 2012, 2013, when we went way up and we came out of the doldrums of the Great Recession, the only thing that made us go down was the fact that interest rates went up. We don't have interest rates going up right now, which is why we have this the appreciation going up at such a fantastic clip. And of course, because it's going up at such a fantastic clip, we have a lot of people out there, what we like to refer to as perma bears, or people that are just always down and they're rooting for something to happen that's absolutely negative. And the bottom line is, these are the people that are saying, yeah, it's going to be a housing crash for sure. It's the housing crash is coming. And then they actually have social media misinformation. They have these vlogs, the video blogs that they put together that is, it's just there to frustrate people. It taps into people's fears. And yet I watched so many of these. And just because they're wearing a suit, standing in front of a camera, does not mean that they have the pedigree to talk about economics. Some of these people are just investors, got lucky at one time, and then they get in there and they try to dissect everything, but they're not looking at the complete picture. That's not what they're trained for. Matter of fact, as far as flipping houses is concerned, I've got a really good idea about how to do it, and it's been in my family for a long time. But now investors, if that's what they do over and over again, that's what they're good at. I don't go to my dentist and tell him how to do my teeth, just like you shouldn't be going to a regular person that is, happens to have a real estate license and had a couple good investments and go there for economic advice for the whole entire country on exactly what's going to happen and pan out next for the economy, and specifically here, the housing market. So really what it boils down to is supply and demand. It's not the fact that, yes, boy, values are going up way fast. So boy, this is like the year 2007 all over again. This thing's going to implode. We're going to definitely crash. That's not what it's about. Instead, you got to take a look at what's really going on in the supply and demand. And we've already talked about it. We have an inventory crisis. The biggest issue is not necessarily the demand side of the equation. It really is the supply side of the equation. And with the supply, what happened going from 2019 to 2020 is we started off the year with very few homes on the market to start off 2020, even prior to COVID. Then COVID hit. And then we got 50% fewer homes coming on the market in April, 40% fewer homes coming on the market compared to the averages in the month of May. And June, we also had a real reduction in the number of homes coming on the market. So you could see that put us kind of behind the eight ball because we already started really low. We had fewer homes coming on the market. And then what happened with COVID-19, we started to see interest rates fall, demand rise before inventory, before homeowners came on the market, even at a normal clip, which they didn't do. There's been a real lack of for sale signs that has added to this inventory crisis. And if you look at the last 3 years, that is 2017 through 2019, and compared it to what happened in 2020, it was actually down 9%. There were 9% fewer homes on the market in 2020, missing 24,000 homes in all of Southern California. So, and some counties were a little more on the extreme missing home for sale signs, San Bernardino being one of those. But across the board, everybody had fewer for sale signs. It wasn't just here, it was everywhere in the United States. And then if you compare to that same 2017 through 2019, January through July of this year, we're still missing 8% the number of homeowners that typically come on the market. And it's down 14,357 homes for the first 7 months of this year. So missing quite a few homes, and that is really exacerbating the problem. And it's not because of COVID. A lot of this is when we have such a low inventory, we have a hard time getting homeowners to place their homes in the market because where are they going to move? Now, a lot of people have been focusing on this inventory, how the inventory came down. And I don't even know why, Fred, this is the Federal Reserve, St. Louis Federal Reserve Board, they put together all of these wonderful charts that you can take a look at, and you can actually put line over lines and do a lot of things. If you're an economist, you can totally geek out like I do, but I don't know why they even have this chart in here. It only goes back 1 year, so it only makes it look like you're looking at the last year. However, a lot of video blogs have taken this as, look, it's going up. Oh my gosh. And you get these guys with the vlogs, once again, the perma bears saying, yeah, it's going up. Things are slowing down. It's a buyer's market. That stuff drives me absolutely insane. So instead, if you look at it, this was just since July of 2020. So this is just the last year. It normally comes down. And then after we get through January, it normally goes up. And I can show you that over time. So this actually, you have the statistics going back further. So I don't know why they have that specific one that only goes back 1 year, because I want to look at the whole entire thing. You can actually change this one so you could see what's happened in the last year. So I'm not for sure certain why they even have included that at Fred. However, if you look at this, on the bottom half, this is or the bottom right hand side, this is that little piece that they're talking about where it's going up, and this is where everyone's going, yeah, look at all the extra inventory, things are totally slowing down. As a matter of fact, in Boise, Idaho, that is where it's going to be the biggest drop in demand, and we're going to get a big inventory, and we're going to get the big crash. The crash for 2021 is starting in Boise, Idaho. And I've even heard that from a couple of video blogs, and it just doesn't make sense, because this is really what they're referring to. If you look at it and look at it going back in time, where we are today going back in time is extremely low, given the history of where the inventory has been. We've not really been at this point in the inventory across the country and locally, where we have so few homes. Even coming off of that very, very low bottom, we're still extremely low compared to where we have been in the past. And so if you actually look at this, it's starting in 2016 on 2017, 18, 19. Each one of those little Himalayas is a year. And if you look at it, each year it's been slowly but surely going down. So that has been the thing. So you haven't been seeing it, but behind the scenes, we've seen the inventory slowly but surely going down. And if you look, this was January of 2017, January of 2018, and January 2019. It always starts off low and goes higher. And then we had the year 2020. Now, I said always until we got to 2020, because it actually dissipated a little bit. Then we started to go up right around when COVID started. And then it just fell like a rock, because we weren't placing enough homes on the market, and we just dug ourselves into a gigantic deep hole, because we started off this year, red alert. It was already bad to start off 2020. Then we started off this year with a record low inventory. And this is across the United States. I've shown it locally, and we'll show that in a second. But if you look at this, these are where the different peaks are. You've got the peak in July of 2017. You've got August of 2017. And this is the peak in the inventory. So typically it peaks during the summertime, or it can a little later in the fall. If you look at August and September of 2018, they were almost identical to each other. I think September had about just a slightly more, but it looks pretty flat right there. But it's August to September, peaks in September of 2018. In 2019, we had the same thing, August and September, pretty similar. September was just a tiny bit higher, because we hit that peak and then it came down. And then we had April of 2020 was where the last peak was. That is not where the peaks typically go. And that is because we weren't placing a lot of homes on the market, and we were behind the 8 ball when we started placing homes on the market later, because demand was already juiced with record low interest rates. So that's why we had that early peak in April, and then it fell. So the big question is, where is it going to peak right now? And I can show you, they don't have the August numbers yet. July numbers yet they do have the July numbers. We don't have August numbers yet for where the inventory is, because they typically do that within the next couple of weeks. And yet you look at this, and where's it going to be? Well, you got the vloggers saying it's going to continue to go up. However, that's not what's going to happen. Instead, we're going to see this peak. And I could show you that. Southern California supply can show you how we're already starting to hit that peak. And this is the active listing inventory. If you look at this, that's that same little U shape that the rest of the United States has. And then we have a lot higher Himalayas for other years. Now, if I drill in, I didn't do that. I'll show you in a second. But anyway, so Southern California active listing inventory year over year. This is as of today. This is where we are. You can see how it's kind of flattening out. So we're reaching that peak. And today we're at 20,643. It's up 1%, or 185 homes. And So it went up 185, not a whole heck of a lot. Last year, we were at 25,473 at this time. That's 23% more than where we are today. But keep in mind, remember, last year, we were far off of where we normally are. Last year, when I was hitting August, I was going, this is a record low for August. We're even further below that right now. And the 3-year average from 2017 to 2019, because you have to throw out 2020 because it was the COVID year. So if you look at normal year, 2017 and 2019, they were at 41,318. That's 100% higher than where we are today, which means double where we are today is where inventory should be at today. That's how far off we are. And that's what it's like in Boise. That's what it's like in all these different areas when I've downloaded the statistics just to see with all these different vloggers, these YouTube vloggers, when they're talking about this crash coming because the inventory is rising. I look at the inventory and it's still far lower than where it normally is for this time of the year. And typically we peak right between July and right around now. And that's where we are right now. You can see we're just about to hit that peak. And that's typically what it is. So where are we going to go from here? We're going to see this inventory slowly drop. I was hoping we'd get higher inventory with higher interest rates, but that is not going to happen for the rest of the year. And so what we're seeing is that slowly but surely, we're going to watch this inventory come down. And from there, once we get to the holiday market, which is the second week in November, we get the cyclical drop. And people go, how in the world can the inventory drop when it's already at a very low level? That's what we did last year. That's what we will do this year, because there are still a smattering of homes out there that have been on the market for a long time that are having a hard time selling for whatever reason. There's millions of different reasons. I've seen homes with purple marble and purple granite and different things like that, and all the whole house turned painted purple. Purple was the theme. That type of thing will not. Those are the kind of homes that if they price it a little bit aggressively, they sit on the market. When it comes to the holidays, they pull their homes off the market and throw in the towel. There still will be some of those that will happen, and we'll watch this inventory drop a little bit further. That's what I'm concerned about, because what I'm starting to see in the numbers is a forecast coming in for 2022 where we start off the year with fewer homes than we did this year. Kind of wrap your head around that, because this year was a record low, and I did not think that we could get any lower than where we are today, but that is what is going on right now. And remember, it really boils down to the supply and demand thing. So we just talked about the problem in supply. Now let's talk about the issue in demand. And demand has been totally fueled by interest rates. And demand, for me, I look at the last 30 days worth of escrow activity. However, that escrow activity and total sales locally and across the country would be higher. We'd have more escrows and more sales if we had more product, more homes coming on the market. But the problem is we have fewer homeowners coming on the market. And I haven't seen if this is going to be a trend that lasts forever. People think it has a lot to do with COVID. My thinking is this: we had a problem coming out of the Great Recession, and we had fewer homes coming on the market after the Great Recession. There was a certain number that would always come on every year, and then it downshifted. People were staying in their homes longer. And now we're really analyzing the importance of our home now that we've stayed in our home after COVID. And I think that there might be a shift with a new trend that comes out of it. We will have to see. It's something that we'll have to continue to watch. But demand has been driven by these low interest rates. And when we hit COVID-19, and that spike right there is exactly where COVID-19 is. And hang on really quick. We're going to have a timeout because we have a special guest. He just got a haircut. Let's see. Here he goes. Let's see. We can lift you up there. There you go. There you go. Because last time I changed the camera, it messed up the distortion of it. But that's a good-looking haircut.
Thank you.
Yeah, it's going to be great for soccer tomorrow. Right on, dude. Right on. Anyway, thank you for that great interruption. We love when the kids come in. That's why I keep my door open. Anyways, so COVID-19 hit, and this is where it hit. And after that, we hit 17 record lows. The 17th was right there. The January of this year, the first week, we hit the 17th record low. These record lows, this goes back 50 years. We kept on hitting one after another, and it kept on just stirring the pot and pushing more and more people to go purchase, because these interest rates were lasting and they were going down lower and lower, and it's just pushing more and more buyers to the marketplace faster than product could be placed on the market, and that was the issue. So we have this. We started to go up after that. You could see that we went up to 3.18% where it says about April right there. It went up to 3.18%, and then it came down. And now we're dealing with interest rates of right around 2.86%. We got as low as 2.77%. So we were getting there. Now it's kind of gone up. It's gone down a little bit in the last week from I think it was 87 down to 2.86. But you can see the bottom line is we have interest rates below 3%. These are just absolutely astronomically low interest rates that are fueling this thing completely. And mortgage projections across the board, we thought we were going to be higher than where we are today. I mean, there's different ranges that we look at, and I thought we'd be at 3.25. You could see we were at 3.18%. It was exactly what I thought was going to happen. I thought we were going to hit 3.25. Then I thought the economy was going to continue to churn and it was going to continue to do well, and we'd get towards 3.5% by year's end. So, and that's exactly what, if you look at this. So everybody across the board, if you look at 2021 fourth quarter, 3.4, 3.4, 3.7, 3.4. So right around that same thinking that we're going to be pretty close to 3.5%. So, but that didn't happen, and that's not what's going to happen for the rest of the year. There's this real stickiness, and really has to do with where the appetite is for long-term investment opportunities. And really, it boils down to that there is a lot of appetite still remains for United States Treasuries. And what you see happen to the 10-year Treasuries kind of is a litmus test of what happens in 30-year mortgages. So that's why people follow the 10-year to see what's going to happen with a 30-year mortgage, because they kind of go hand in hand. And there is a sway to 10-year Treasury and 30-year bonds because it has to do with long-term investing. So if you look at this, from August of last year all the way until April, it looked like the 10-year Treasury is going to continue to go up, and we're going to go back right where we were before, which was between 3.5% and 3.75%. That's what it looked like. That's what the trajectory is going to be. Then once we got all the way up, there was still COVID that we were dealing with. There was still worldwide slowdowns and problems and things like that. So that's really the miss, where the 10-year Treasury got up to where it needed to be. And then after that, it started to come down. And that's what we've been dealing with, is this 10-year Treasury that is having a real problem getting that much higher than where it's at right now, dancing around that 1.2 to 1.3 is what it seems. And if you look at what's happened in since the beginning of time that we have this analysis going back for the United States Treasuries, if you look going back to 1981, you could see that the 10-year Treasuries have been on a downward slope, and for quite some time. So if you look at that since 1981, it's been slowly but surely coming down. Yes, you have your volatility, but overall, it's been this path down to where we are today. And there's many reasons why this has happened. There's books written about it. There's quite a bit written about it, but you got to geek out and get into the weeds. And I'm not going to get there with you guys, but just understand that there's this pressure for interest rates to continue to ride lower and lower. And if you look at interest rates, they too have been going since 1980 on, where they have been going at a downward trajectory, and it continues to go. So that's what we're dealing with. We're not looking at 5% interest rates, and 5% interest rates would be too high for where the ranges are, and we're not going to get there anytime soon. We're going to be stuck right around that 3%, or could be even lower. If there's any kind of stock market correction, I've told people that we could see interest rates at 2.5%. So can you imagine what that would further do to the housing market that is so incredibly hot? Can you imagine what it would do if we had interest rates even lower? It would be hard to imagine, but it could happen. And then a lot of people are bringing up the fact that the Federal Reserve is playing so hard in here. It really does not change much at all, the interest rates, the fact that they're playing so hard and buying mortgage-backed securities. And that's because they've been doing it for quite some time, where they have bought mortgage-backed securities and then they stopped. Well, I want everybody to understand this. In 2014, they talked about tapering, and that's where they tapered their bond purchases, where they were purchasing loans that the whole entire real estate industry was putting together. You know, all the refinance loans, all of the purchase money loans. They were purchasing these at a pretty giant clip until they got to 2014, where they said they stopped. However, what they didn't tell you is the fact that when somebody refinanced their house, or sold off their house and that loan was then paid off, they would go ahead, the Federal Reserve would go ahead and reinvest that. That's why it was flat for all those years, because it should have come down. It did not come down until we got to 2018, where they not only stopped that tapering and buying of mortgage-backed securities, but then they stopped reinvesting. People that had refinanced or sold off their home or paid off their loan, they weren't reinvesting it. And so there was a downward trajectory until we got to COVID. Then when COVID hit, boom, we're going right back. They were purchasing mortgage-backed securities and reinvesting anything that was refinanced. So that's why you get this weird-looking line that continues to go up, and went from about 1.3 trillion all the way up to 2.4 trillion, which is where they are today. That's their total basket of mortgage-backed securities that they hold right now. So, and where do I think it's going to go from here? If they do taper, it's going to go flat. Why is it going to go flat? Well, you've got to read when they're talking about Fed tightening, read the fine print. Just know that I'm the one that geeks out on this. I'm the one that looks at this stuff. There's a lot of people that don't, but I think it's quite interesting to read about this. So what the plan is for August 13th through September 14th is for them to purchase $40 billion of new mortgage-backed securities that are going to continue to add to how much they are taking on. Now, what you don't know is that it's not just 40 billion. There's 60 billion that is being refinanced. People sell their house, so they're reinvesting $60 billion on a monthly basis. So when they're talking tapering, they're only talking the 40 billion. They will continue to reinvest that other part for quite some time. I don't know when they'll be shutting that off, but you know that this is stages that they do everything in. And so I want you to know that they've been talking about tapering and done such a great communication job compared to what they did last time, that this time that the taper is already baked into the 10-year treasury. If they start to taper, you're not going to see interest rates all of a sudden spike upwards. It's already baked into the 10-year treasury and long-term investments. And the Wall Street Journal, if you look at this, I want you to see this, that on the right-hand side, you can see United States Treasury yields 1.28%. So you can get 10-year treasuries and get 1.28% return. But you compare that to all the other basket of 10-year treasuries around the world. And look at this. You've got UK at 0.5. You've got Sweden at negative for Spain, negative for Portugal, Netherlands, and it's just extremely low for these countries. So you just understand, I mean, not negative for those other, I mean, it's really small, 0.081%. It's negative only for Netherlands and for Germany and for France and Belgium, but those are all negative. And if you look at Japan, 0.017%. Where are you going to park your money if you're a worldwide investor? You're going to park your money in the United States government, United States 10-year treasuries. You can do it in Australia as well. The only other places that really you can get more return, more bang for your buck, there's certain countries like Mexico or India. Those are the countries that have a little bit more economic turmoil, and you might not want to invest in their sovereign debt. Anyway, oh my gosh, I've got a couple of kids that are coming your way. One of them is Athena Rose. You can't really see her, so I got to put her up because if I adjust it, remember, something happens. There she is. It's Athena Rose, ready for a weekend. We're going to have a soccer tournament this weekend, right?
Yep.
All right. And this kid, he just got back from cycling from middle school. Anyways, what are you doing this weekend?
Soccer tournament.
Soccer tournament. She too is having a soccer tournament. So let's go. Let's kick some behind and have some fun this weekend. Right on. See you in a moment, girls. Anyways, just know that these low interest rates are here to stay, and it's going to continue to fuel this incredible demand. And as a result, SoCal demand has been extremely hot. This is the last 30 days worth of escrow activity. And if you look at this, you could see where it's actually risen a little bit recently. And that's because these low interest rates have been really sticky at below 3%. And today it's at 18,717, the number of pending sales. It's up 1% or an extra 251 pending sales. And that's where it is today. If you look, it's actually, that was the law. I don't know why I put it on there this year or last year, but it's the largest rise since the end of April. So we actually had a big rise in the last 2 weeks, up 251 pending sales. And a lot of that has to do with the fact people were getting in right at the end of summer and also these low interest rates, the combination of the two. Last year, we were at 21,508. That's that green line. 15% higher than where we are today, 2,791 more escrows. So people say it's slower than last year. And part of the issue is because we had a delayed spring. That's part of it. The other part is they had more inventory to work with last year compared to this year so that they could place more into escrow. We have fewer homes on the market and fewer homes coming on the market right now than we did at last year at this time. And the 3-year average is 16,757, which is 12% less than where we are today. So you can see, if you look at the averages, we have way less inventory, but we have a lot more pending sales as well. So the 3-year average is less than where we are today. And which means that we're going to continue to have this auction-like atmosphere. We're going to continue to have homes sell for over the asking price. That is the theme for 2021. And as far as demand is concerned, where we typically peak right here between April and the end of May, that is exactly what happened. We peaked almost, it was a March peak, but then we later on peaked at the end of May on the right-hand side. And where are we going to go from here? It's going to continue to go down, even though we're getting this blip. It will go down because we're moving on to another season. And then at the very, very end of the year, it will fall further. And that is the holiday market. Happens every single year. This year will be no exception. There just won't be enough product to place in escrow because a lot of people will not place their homes on the market during the holidays. And so how fast is our market moving? It is moving fast. And you can see it's kind of flatlined. Here it is, 33 days. It's flatlined and it's been here for 6 weeks. So 33 days, it's just like hanging out at a very low level. And it didn't change any in the last 2 weeks. Last year, we were at 36 days at the same point in time. And so a little bit slower than where we are today. The lower the number, the hotter the market. And my rule of thumb is anything below 40 is insanity. And that's where we are today. The 3-year average is 76 days. And you can see below this black line is a seller's market. And the lower you get, the hotter the market. And like I said, when you're below 40, it's insane. And that's where we are. And that's where we will continue to be. And we will play underneath of that 40-day average for the rest of this year. So that is where we're going to be for all of 2021. And the expected market time, same thing. You can see it's kind of like there's that little U where things got really busy during the spring. This happens. That's why you get this up and down, up and down, up and down. So we get the same thing. Spring is the busiest, and then it slows down a little bit in the summer. But then it goes flat for the rest of the year. As a matter of fact, if I zoom in here, if you look down there on the right-hand side, that there looks like to be a little plateau. And that's what it'll look like for the rest of the year. It's going to kind of plateau for the rest of the year until we get to the start of 2022 when it drops further and gets a little bit hotter during the spring. And so we're starting the fall market. You can see my kids just got back from school, which means that is what I refer to as the fall market. Because if you've got a big family, you might move over the next few weeks. And you might have had your kids going to their next house that you're going to be living at, that school that is where that house resides. You might do something along those lines, but it starts to wane because it's not the best time of the year for families to make a move. Inventory slowly drops from here, and demand slowly drops as well. And people go, well, it sounds like it's slowing. It's not, because you have the inventory dropping at the same time that you have demand, because families, they're not going to be looking to purchase as much in the fall as they were in the spring and the summer. So it comes down a little bit, but they both go down at the same rate. So when you have fewer homes on the market, which is hard to believe, but that will happen, and when you have fewer escrows happen, that is at the same velocity. If you're out in the marketplace, it still feels the same, like it's not changing. So that's the flavor of the market that you get right now is the flavor of the market for the rest of the year. And it has everything to do with, we transition to the autumn market, which is the kids are back in school. And so my take is, you know what, have an economic model. I have a quantitative economics decision sciences major where I like to totally geek out on that. And I don't throw that out there just as bragging rights or anything. I want you to understand that this is something you can believe in. What I am putting forth is something that you can believe in because this is what I do. This is what I love, crave, and I look at all of the numbers and data and get excited about it, talk to my wife about it, and she has to nod her head and try to be as excited as I am because she can't be, because that is my passion. And I like to share it because I want to properly set people's expectations by looking at everything. If I thought I saw a crack, or if I thought something was going to happen, I would let everybody know. Kind of like what I saw in 2005, in the fall of 2005, when I started to see a difference in the inventory, especially in 06. And then it was in 07 and 08, we saw more and more and more homes. There was an imbalance in the inventory. So that's because I was following an economic model, and I hope that you do the same thing instead of following these video bloggers and those guys that say, I know what I'm talking about, yet they don't have the credentials that back it up. And when I listen to these things, they frustrate me to the point where I've even actually commented on a couple of them, and I've yet to have any of them respond, but I have a whole bunch of other people that are responding. It's because they want it to happen because they've missed the opportunity to purchase right now. So they want it so bad for there to be a crash that they have that opportunity, but they're going to miss out if they have that kind of stinking thinking. So I want to properly set people's expectations. So don't listen to these video blogs unless they really absolutely have the credentials to back it up, and all the data and the supply, all the information and statistics and charts. So if you want a copy of this, you have to be a subscriber to my report. So if you're not, go to reportsonhousing.com to subscribe. You can ask for a copy. I'll be more than happy to give you a copy of this. So go to reportsonhousing.com if you're not, and subscribe. Get a free month. It's $15 per month or $150 per year if you utilize month free, if you utilize the coupon code August. I'd like to thank my buddy and your buddy, Kevin Buddy at Monarch Coast Financial. Deals with everything from full doc to private money loans and everything in between. He's been doing this since 1976. He's got loads of experience, and you know what? Give him a call. He can help you. He can help your clients. 949-422-2075. That's 949-422-2075. Thank you, Kevin, buddy. My buddy, your buddy, Kevin buddy, thanks a lot for your continued support. That's all I've got. If you have any questions, go ahead and load them up in the comments. I'm going to go ahead and answer those when I get them. I've seen a number of them come through. So you know what? The bottom line is I will answer them. I just don't want to take up any more of your precious time. I've already done a little bit over a half hour, which is further than I wanted to go, but I was passionate about this one. I really wanted to talk a bit about exactly what's going on, how we got here, and I want for everybody to see really what's going on and why we're here and where we're going from here. So thank you very much. I appreciate you tuning in. Have a fantastic weekend. I'm having a soccer weekend. We will see you on the other side. I appreciate it, and have a super fantastic weekend. Thanks much.